Tuesday, the 27th of June. Welcome everyone to the program. This is Business Morning and the second day of national holiday here in Nigeria for the celebrations of the end of Ramadan. The markets will reopen tomorrow. Later on the program, we'll give you a sneak preview where the markets finished off on Friday and what to expect the new market week to look like. But of today, it's going to be a lot more about infrastructure. So let's start from where Channels Television's global headquarters is. That's Lagos. The governor, Akinwumi Ambode, says the next 2 years of his administration will focus on three major areas: power and the environment and transport. According to the governor, he says that these three areas will be used as key sectors that will drive every other social infrastructure that Lagos State will be handling. Of course, the news is already out that Lagos State has been granted permission by the federal government to reconstruct the popular Murtala Mohammed International Airport Road, and we expect a tolling to be there. We'll have that conversation today. Lagos is Nigeria's economic epicenter. That's not news. So, but what is going to be new in the new airport road that will be reconstructed, and the logistics problems we have with the Apapa port and other infrastructure, and of course the bigger story around the national infrastructure, key economic infrastructure and logistics. Stick around for Dr. Ajadi from Lagos Business School having that conversation with us here on the program. But of course, it's been in the news over the last few days, the face-off between the Power, Works and Housing Minister, Babatunde Fashola SAN, and the National Assembly members trading war of words over projects and budgetary provisions in the newly signed fiscal document. As the word on the street goes, the devil is in the details. Now the devil seems to be emerging as to how the budget 2017 was packaged and signed. Remember, the long delays in the budget took nearly 6 months for it to get to birth from the National Assembly to the executive. Now, on bundling this budget, we're now having details. The first part of this between the National Assembly and the Honorable Minister in charge of Power, Works and Housing. The HM, Honorable Minister Fashola, says that the National Assembly is accusing the National Assembly of materially, and that's very important, materially altered budgetary provisions for at least 4 infrastructure projects. The first one was the one just close to where Channels Television is located. In case you haven't checked that out on Google Map, just try that. Lagos-Ibadan Highway, that's just in front of us over there. And the minister says there is no concession on that road. Of course, remember the Baikotni brouhaha since 2006. We spent more than a dozen years trying to fix that road, and it hasn't really been finished. The minister says the ICRC, that's the agency responsible for regulating concessions in Nigeria, got some bank loans together, and that's what's been used to fix that major economic highway that leads directly into Nigeria's economic heartbeat by the name Lagos. The second was the Bodo Boni Road. That's way down there in the south, and the second Niger Bridge, which was part of the discussions in the Jonathan's administration, and is also crawled now into the Buhari's administration. And of course, the power project in Mambila, that hydropower project that is already ongoing. The minister says the National Assembly members materially altered the budgetary provisions for those 4 projects. So the minister says that the alterations by the National Assembly were never discussed during the ministerial budget defense that took place a couple of months ago. Meantime, the National Assembly members have also fired back and says that the minister is spreading half-truths and making fallacious statements. Let's talk about doing business in the banking sector. One of the worst hit by the specter of 2016 economic meltdown, with the impact on lenders in Broad Street. Of course, the numbers from 2016 were surprisingly positive for a number of the banks, in particular the Tier 1 lenders listed on the market. Demola Sogunle is the Chief Executive Officer at Stanbic IBTC, one of the Tier 1 lenders, and he speaks to strategies for survival and outlook on what lies ahead. Let's take a listen.
What has changed? I mean, in our industry, in the banking industry, I can tell you categorically, 2015 was very tough. Tough within the context of the fact that we saw the impact of the recession, right, on the quality of our loan book. Whether you are talking about the corporate loan book or the personal loan book, right? Those who lost their jobs after they've been given, whether you are talking about personal loan, secure personal loan, unsecured personal loan, or mortgages, they were just not able to pay. Right. What happened to those loans? They became impaired. And so you will remember the look in 2015, you were talking about NPL ratio, non-performing loan, as a percentage of total loan book. Right. Ratios above 20-25%. For some banks, massive. So banks have had to, haven't impaired those loans. It means it is an erosion of capital. 2016, also similar. So that's on one side. When you're talking about, FX illiquidity, there was just no FX. Manufacturers could not, produce. So what have we done? Because is a challenge, or it was a challenge, it's still a challenging environment. One of the things we've done is to start looking at companies who, when you look at them, right, you want to bank companies that are in the sectors of the economy that you can do backward integration, right? Companies who are operating in such a way that their reliance or their dependence on foreign currency, is modulated or is moderated to the extent that is either they are able to source locally their raw materials so that they can continue to be in business, right? Or they are also in a position to export so that they can, generate FX with which they can use to bring their raw materials in. You look at them. We look at, I'm talking about changes that we've had to make. We are also talking about companies that when you look at where they operate, maybe they are in the consumer segment, in the conglomerate, where, whatever it is, they are still able to go through, a period of hardship. So those are some of the changes that we've had to make in order to be able to do that. And if you look at the banking system as a whole, right, because of what has happened, we had no choice than to start looking at how to reduce cost. Cost to income ratio for the banking industry, the average, if you strip out one or two banks that you can call outliers, the average, at times you could be talking about something close to 60, you could be talking about something close to 65, right? By trying to reduce costs, you want to go, the digital route. You can't continue, to roll out branch network. You can't continue to do things in a manual way, right? Because if you deploy technology, you'll be able to render faster services. You'll be able to render, services whenever, however, wherever you are, right, without necessarily incurring the cost associated with it. So rationalization is taking place. If you remember, look, about 2-3 weeks ago, a bank announced the fact that, look, they are trying to shut down almost 70 or so branches, right? So everybody has got to make those changes. So we've had to make changes in terms of our own cost profile. We've had to make changes in terms of the channels of delivering our products and services. We've had to make changes in terms of our own internal operations, trying to be digital end-to-end. It's not just at the customer interface. Middle office, back office, we've got to do that. At the end of the day, we also have to make changes in terms of the sectors that we are meant to concentrate on. We are looking at agric now because we know that, look, given what is happening, whether it is with specific, whether specific subsector within that agric, value chain, there are some key players there you can partner, you can bank with. So we've had to look at that, and hopefully we can leverage some of the experiences that we've garnered, from these last 2 years, to move the industry forward.